A $5 trillion wipeout, billions in liquidations. Bitcoin has pulled back significantly from its $126,000 peak. If your portfolio is showing red today, you are part of a global phenomenon. We have analyzed the latest institutional reports to understand if this is a structural market end or a massive reallocation of wealth. Today, we break down the data behind the chaos. This isn't just about digital assets. We are seeing a rare correlation spike where even traditional safe havens are reacting. Gold recently touched record highs above $5,000 before experiencing sharp profit taking. Globally, from the New York Stock Exchange to emerging markets, the sentiment has shifted to extreme fear. Investors are moving away from risk on assets as geopolitical tensions create a cautious atmosphere. Why is this happening now? We've identified 4 major triggers. First, the regulatory deadline for the Crypto Clarity Act is creating institutional uncertainty. Second, the nomination of Kevin Warsh as the next Fed chair has signaled a potentially hawkish turn, meaning higher interest rates for longer. Third, geopolitical friction in the Middle East is driving oil and energy concerns. And finally, a massive leverage flush has seen billions in forced liquidations, clearing out the speculative market. While retail investors panic, what are the whales doing? Data shows that major digital asset treasuries and institutions like BlackRock are not selling, they are rebalancing. They view this volatility as knowledge arbitrage, where those who understand the long-term math profit from those who trade on short-term emotion. Even as major holders see their average entry prices tested, their long-term conviction remains unchanged. Technically, all eyes are on the 200-week moving average. Historically, this has been the line in the sand for market cycles. The Relative Strength Index, or RSI, is currently at levels we haven't seen since the 2020 liquidity crisis, suggesting that the market is severely oversold. Analysts suggest that if these psychological support levels hold, we may see a period of accumulation before the next leg up. How do you survive this? Professional traders rely on 3 pillars. First, dollar cost averaging, avoiding the urge to time the bottom and instead building positions slowly. Second, removing emotion through AI automation. Tools like Pionex, 3 Commas, and CryptoHopper allow for 24/7 grid trading, which profits from volatility rather than direction. This is how sophisticated desks manage risk when they aren't at their screens. A word of caution: during market panics, bad actors become more active. We are seeing a surge in unverified pre-sale scams and fraudulent launchpads promising guaranteed returns. Always stick to established, regulated platforms and never connect your primary cold storage to a website you don't trust. In a bear market, security is your best investment. History reminds us that markets move in cycles. Periods of maximum fear have historically preceded the most significant recoveries for those with a 5 to 10-year horizon. Are you holding through this cycle? Or are you waiting for lower entries? Share your strategy in the comments. If you found this data-driven analysis helpful, consider subscribing for more high-signal updates on the global economy.